If you're a startup founder, you know there's this one moment you both dream of and, let's be honest, kind of dread. And that's when you get your first term sheet. It's the key to building your vision, for sure. But wow, is it filled with confusing language? So today, we're going to demystify two of the most critical and confusing terms out there, the valuation cap and the discount. Getting these right can honestly be the difference between a great deal and a really costly mistake. Just picture it. You've poured your heart and soul into your startup. An investor is finally ready to write a check, and they're talking about using a safe or a convertible note to get that money in the bank fast. It is an incredibly exciting moment. But then the term sheet arrives, and all of a sudden you're staring at this fine print that is literally going to define the future of your company. And this is where so many founders find themselves, right? You're in the meeting, you're nodding along like you get every single word because you absolutely need that capital to keep the lights on and keep building. But inside, you're asking, what does this actually mean for my ownership? What am I giving away here? It's that classic battle between needing to move fast and needing to be smart.
But hey, don't worry, we've got a roadmap for this. We're going to start with that confusing term sheet itself. Then we'll break down exactly what a valuation cap is. After that, we'll tackle the discount. Then the really important part. What happens when both of them are in your deal? We'll look at the real cost of capital, and we'll wrap it up with a playbook so you can raise smart. Let's get you from confused to confident.
Okay, first up, the valuation cap. Honestly, the best way to think about this is as a price ceiling. It sets a maximum price for your early investors' shares when their investment finally converts into actual equity in your company. Now, here's the thing you absolutely have to get right. This is not a valuation of your company today. That is such a common mistake. Really, it's a promise to your earliest backers. It's you saying, hey, thank you so much for taking a risk on us this early. When we go out and raise a proper funding round with a real price, your investment will convert at a valuation no higher than this cap we agreed on. And you've got to see this from both sides. For you, the founder, it's that ceiling on the conversion price. But for the investor, it's their protection. I mean, think about it. They're betting on you when you are at your absolute riskiest. So if you hit a home run and your valuation just skyrockets, that cap makes sure their early faith is rewarded with a meaningful piece of the company. And this example makes it super clear how it works in the real world. Let's say you agree to a $5 million cap. A year goes by, you're crushing it, and you raise your Series A at a $10 million valuation. Awesome. But here's the deal. Your new investors, they're buying shares at that $10 million price. Your early safe investor? Nope. They get to buy their shares at the much, much lower $5 million price. They get way more equity for their money, and that's their reward. All right, now for our second key term, the discount. So if the cap is a price ceiling, you can think of the discount as, well, basically a coupon. It's a much more straightforward reward for believing in you early on. The definition is pretty much right there in the name. It's a percentage off the share price of your next funding round. It doesn't set some hard limit on the valuation like a cap does. It just guarantees that your early investor is going to pay less for each share than the new folks coming in. So why would you even use a discount? Well, a lot of the time, it's because it's just way too early to even guess what the company's worth. A discount is clean, it's easy to calculate, and it basically lets everyone agree to let the market figure out the price later, while still making sure that first believer gets a nice little bonus. And the math on this couldn't be simpler. If your new investors are paying $1 a share, that early investor who has a 20% discount gets to convert their money into shares that only cost them 80 cents each. So for the exact same investment, they get more shares. Simple as that. Okay, so we've got valuation caps and we've got discounts. Pretty straightforward, right? But what happens in the most common scenario when a term sheet has both a cap and a discount? This, my friends, is where so many founders get tripped up. Here it is, the golden rule. You have to burn this into your brain. When both a cap and a discount are in the deal, the investor gets the better deal. The math literally chooses for them. Their investment will automatically convert at whichever price is lower, the one calculated from the cap or the one calculated from the discount. They get the best of both worlds. Let's just walk through this table because it makes everything so clear. Look at the top row, the high valuation scenario. Let's say you raise at 20 million bucks. The share price based on your $8 million cap is only 40 cents, way lower than the discount price. So boom, the cap applies. But now look at the bottom row. In a lower valuation round, that 20% discount actually gives the investor an even better price than the cap does. So the discount applies. You see? In every single case, the investor gets the lowest possible price.
So now we get the mechanics, but what does this all actually mean for you, the founder? We have to talk about the real cost of this capital, and it all comes down to one word: dilution. It's about how these early terms shape your long-term control of the company you're building. This is such a critical point to understand. When you sign a safe or convertible note, nothing really changes on your cap table that day. It all feels kind of abstract. But that piece of paper is a promise for future equity. And the moment that next funding round closes, all those promises come due. They all convert, and the true ownership picture is suddenly revealed. The impact is delayed, but trust me, it is very, very real. And just look at how massive that impact can be. Let's imagine a scenario where your big price round is at a $15 million valuation, but your early investors have a $5 million cap. They get 3 times as much equity for every single dollar they invested compared to your new Series A investors. 3 times. That is a huge difference, and it comes directly out of the ownership pool for you, the founders, and your employees. A chart like this just makes the whole idea of dilution painfully real. You might start out feeling like you own, almost all of your company, but after just 1 or 2 rounds of these notes converting, your ownership stake can shrink a lot. Now, this isn't necessarily a bad thing. It's how you grow, but you have to go into it with your eyes wide open. Okay, I know this might all sound a little daunting, but here's the good news. Now that we've identified the pitfalls, we can talk about the solution. So let's pivot to an actual playbook for how you can approach your next negotiation strategically. This is all about raising smart, not just raising fast. Here are 3 big red flags to watch for. First, a cap that's just too low. Don't just accept a standard number you heard somewhere. Do your homework on what's fair for your market. Second, try to avoid stacking up a bunch of different notes with different terms. It creates a huge mess on your cap table that can scare off later investors. And finally, never ever ignore the gap between your cap and what you think your next round's valuation will be. The bigger that gap, the more dilution you're going to face. So what do? It's simple. You do the math. Before you sign a single thing, you have to model this out. Get a simple spreadsheet, project a few different scenarios for your next round, a best case or worst case, and a realistic case. For each one, calculate the dilution you'd get from the cap, and then the dilution you'd get from the discount. Whichever one is more dilutive, that's your true potential cost. That is the number you need to be okay with. And really, that's the bottom line here. These terms, they aren't just legal boilerplate. They are fundamental trade-offs you are making about the future of your company. So please, model the math, really understand the potential outcomes, and raise your capital with clear intention, not just with blind hope. So I'll leave you with this question. The next time a term sheet lands in your inbox, you're going to be armed with all of this knowledge. You'll know the right questions to ask, you'll know the math you need to run. So what are you going to do differently to protect your vision and your ownership?